Hi, welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Wes Gray. After serving as a captain in the United States Marine Corps, Dr. Gray received a PhD and was a finance professor at Drexel University. His interest in entrepreneurship and behavioral finance led him to found Alpha Architect. Today we'll be discussing his new book, The Do-It-Yourself Financial Advisor. Wes is always a great guest on this show. Let's ask him 5 good questions. All right, welcome back to the show, everybody. My guest today is Wes Gray, author of The Do-It-Yourself Financial Advisor. Hey, Wes, thanks for coming back on the program.
Yeah, thanks for having me. Look forward to discussing our latest book.
Yeah, let's jump right into it. So question number 1. You were a Marine, and how do you think that prepared you to be a better investor, and specifically about the investment advice that you came up with for the Do-It-Yourself Financial Advisor?
Sure. So kind of 3 lessons learned from my military experience and also just being an investor for a long time is, first thing is make processes systematic. As you're familiar with like Kahneman's book about the whole argument about system 1, monkey brain, and system 2, computer rational brain. Usually whenever you're in a situation where there's stress and chaos, system 1 brain starts to creep in and you want system 2 brain doing all the decision making. So in a military context where obviously there's a ton of chaos, or in a market context where there's a ton of chaos, we're just all about systematic decision making, and that's just a lesson learned obviously from military. Another thing is just being disciplined. Like you have a process, you think it works, it's evidence based, and then just following the model. So in the military, maybe like your guns jammed, tap rack bang is like a concept like to get your weapon out of a malfunction. You just follow that model, because if you don't, you'll miss one step because you're like, oh, I don't need that step. That's for losers or other people, and then that's usually processes and systems are there for a reason. Someone died learning about it, and I think investing's the same thing. So
I've heard it said before that I think it was maybe a Navy SEAL commandment, but the more I sweat in peace, the less I bleed in war.
Exactly. You got it. And
that applies to investing too. You got to have your processes in place before the war starts.
Yeah, exactly. Because when the war starts, you're going to want to buy and sell and maneuver and second guess, and now you got system 1 problems just all over the place, and that just destroys people. So we want to try to avoid that in a military context, to not die, and in an investment context to hopefully preserve capital and then have opportunity to participate in upside over time.
Right. Question number 2. There were 3 myths that everyone seems to believe that you found no evidence for to really support them in the book. I found that really interesting. Could you tell us what those are?
Sure. Yeah, I brought in a few others here just when you wrote that question down, so you can read the ones in the book. Probably the biggest one is related to the Warren Buffett meme. So a lot of people get confused with the idea that value investing is about, originally the Ben Graham version is just buy cheap stuff with margin of safety, period. There was really no consideration for quality or looking forward, whereas Warren Buffett's kind of flipped that on its head, where a lot of people think that we should consider value investing to be across the spectrum of price. So maybe like Coca-Cola at 20 is a good deal, whereas maybe the manufacturer at 5 times earnings is a crappy deal, because we want to consider the quality component. And that's great. It's a great story, and obviously Warren Buffett, if you believe that story and actually didn't look into the weeds of what he actually does, you might consider that we'd want to consider quality at at a high level, just like we would like valuation. Mm-hmm. But empirically, there's just no evidence for that, and intuitively, it makes a lot of sense. Like, why would quality as a standalone be underpriced? Like, everyone knows that Google's a great company. Everyone knows that Facebook has great horizons and a great future. So why would you think there'd be some sort of
Mispricing.
behavioral reasons, mispricing, exactly. So I think that's basically a myth. And that just tied into a broader myth about, growth matters. One of our VC guys has a great statement where he says, businesses are all about adding value and capturing the value. Whereas if you have a great business that adds a lot of value to society, that doesn't necessarily mean it's a good investment, because if they can't capture the value,
Right.
they're not going to make money. And so an example is like, the classic airlines or automobiles, where even Buffett says, hey, airlines obviously change the world, but they're crappy investments because
Right.
they add value but don't capture it. And I think that's another myth.
It all goes to the consumer, basically.
Yeah, it all goes to consumer, and you can make an argument like right now, like robo-advisors, like Wealthfront or Betterment, where these guys are basically in a race to the bottom to essentially give away investment advice for free. That's maybe going to add a lot of value to consumers in society, but it's unclear to me how they're ever going to actually like make money as a business. So you see examples of this all the time. So there's a lot of myths out there, but a lot of them revolve around that. I think like quality matters, high growth matters, great stories and future earnings growth matters. None of that matters. Price matters. Period. At least that's what the evidence suggests.
That's a perfect segue to question number 2 or 3. Sorry, because there's a chart in the book that I found. It was amazing to me because it goes against everything that you would think conventionally. And what it was future earnings growth rates sorted by valuation, and then what did they look like in 5 years' time? Basically, like had that growth really materialized that basically people were paying up for? What can you explain what's going on there with that chart?
Sure. So going way back to 1992, Eugene Fama-Ken French had that paper on cross-sectional returns where they say, hey, it seems to be the case that these cheap stocks earn outsized returns. And then they tried to make the argument, because they're obviously from Chicago, my place, that it's efficient. It's because they're higher risk.
Right.
And then there's, another group came out, Lekanshuk, Andre Seifer and Rob Vishny, and they have this paper in the Journal of Finance in '94, which is where that chart's made, where they say, listen, we think value is not driven by risk entirely. We think it's driven by mispricing because investors have poor expectations about the future. And what that chart shows is that clearly embedded in current prices are expectations about the future that are related to the short-term past. And so the question is, are those expectations systematically incorrect? And what that chart basically highlights is, yes, they are. The firms that have historically had really good, exceptional earnings growth rates in the future, on average, never perform as well as expected, i.e. the growth stocks, and that's why they underperform. Mm-hmm. Whereas the value stocks, historically, a lot of times they've had, crappy short-term performance that gets obviously extrapolated in the future, but on average, it's never as crappy as thought. And when expectations change, you make money. And that basically they highlighted that is the value anomaly. It's what Ben Graham talked about, 50, 60 years prior to them writing the formal academic paper on it.
So really, it could almost all be summed up just reversion to the mean, basically.
Yeah. Overreaction to poor fundamentals is what drives the value premium, and overreaction to positive fundamentals is what drives the reason growth stocks tend to underperform on average.
Yeah.
Got it.
So question number 4, it can be really difficult to stick with a strategy when it's underperforming. It's just incredibly hard. You feel like an idiot, especially over a sustained period of time. Is that possibly what you pay an expert for, is to have that professional level of perseverance when you're underperforming?
Sure. So one of the arguments, the title of that new book is DIY Financial Advisor. and we've already gotten a lot of hate mail from advisors who are like, hey, you guys are screwing up the business. Like, what the hell is going on? But we make very clear towards the end of the book that this is just a solution for someone who really believes they can look at themselves in the mirror and say, yes, I can follow a process and be disciplined and stick to it. But many people are very aware that that is not possible. And we talk about the benefit of having an intermediary or an expert or professional essentially serve as your psychology coach.
Right.
And even if they cost like 1 or 2% a year, you could argue in a vacuum that's insane because you could DIY and save that 2%. But if you're going to jump off the cliff when your value strategy's been sucking wind, and then that's right when you jump off the cliff, it goes up 100%. Paying an intermediary that protects you from yourself is clearly worth the cost of admission if you don't have the discipline to do it. Basically, follow the model.
Yeah, that 1% doesn't look that bad at that point.
Yeah, psychology coach, a good psychology coach, i.e., an advisor, an expert, or someone that's protecting you from yourself, is worth their weight in gold if you're someone who's prone to make bad decisions. So definitely, you got it.
So question number 5, and not to give away the final conclusions that you guys come up with as recommendations for a DIY FA.
Mm-hmm.
I liked how you ended up with a sort of an all-weather portfolio that you kept adding layers of things that you saw that statistically and through research kept adding a little bit of edge to that portfolio. Can you just walk us through the quick and dirty of that, just to get it? Because I do think people need to still read the book to understand what they're doing and to have the conviction to actually follow it when it's not working. But at the same time, it's very interesting.
Yeah. So the first half of the book is basically to set the stage for people to realize that a lot of times experts are just full of crap, and a lot of times they use psychology or marketing tactics to make you think like they're adding some sort of value when the reality is they're not. So that's what the first half of the book is just to pull away the smoke screen and say, listen, a disciplined person who invests a little bit of time can DIY. And then the second half of the book is to build what you're talking about. And we basically break it down into 3 elements. The first element, if you run like a globally diversified kind of endowment portfolio, is asset allocation. And honestly, asset allocation can go incredibly complex. People win Nobel Prizes for, whiz-bang models that, I teach in class and we write about all the time. But what does the evidence say? The evidence says that as long as you allocate across a broad spectrum of assets, even if you just use the 1/n rule, like if you have 10 assets, you put 10% in each of them, that's going to get you in the same spot that if you did like a mean variance optimization algorithm when we look out of sample. So bottom line for asset allocation, keep it simple, stupid. Period. Yeah. And so we're not going to tweak on that too much, except to say that, hey, here's a few asset classes that everyone should consider. Stocks, bonds, and some sort of inflation, real return type things like maybe real estate or commodities. So that's easy. And then the second one is, well, that's great. The outside option is to always buy the Vanguard fund to get, say, S&P 500 exposure because it's super tax efficient and basically free.
Yeah. Low friction.
Low friction. Like that's where we're going to start as a baseline. But can we add any value over that in a systematic, kind of robust way? And then, if you've looked at enough evidence and ran enough numbers and done enough studies and basically read financial literature over the past 100 years, it's very clear that there's 2 core anomalies out there. Value, buy cheap stuff, and momentum, buy things that recently have been performing well. Those 2 systems and those 2 concepts applied to the security selection level, especially when combined in an equity portfolio, over time seem to do a hell of a lot better than just buy and hold Vanguard funds. So we kind of walk through some basic ways a DIY person that doesn't have a full quant shop or whatever can do that. And then the third element is risk management. So it's all fine and dandy to, buy and hold and, hold some stocks and bonds and don't mess with it. But the reality of that is you're going to eat 40, 50% drawdown sometimes. And that's fine. Buy and hold is in some sense easy. And it's low frictional. It's easy to tax manage. But we wanted to ask the question, if you wanted to know what does the evidence suggest for a way to risk manage a portfolio and engage in this, this nefarious concept of market timing, which a lot of people just think is like, pseudoscience, and that's fine. But we're just going to say, hey, if you want to just be an evidence-based investor, not a religious-based investor, just because, Ben Graham told you don't do market timing, what does the evidence say? And what the evidence basically suggests when you really dig into it is that, trend following momentum type market timing rules, simple technical analysis, at least give the investor a fighting chance, at least historically, to basically avoid huge market drawdowns and still get to participate in a lot of the upside. So that's a nutshell. Simple asset allocation, value momentum and security selection, and trend following for market timing. If you add those elements in the portfolio, you're basically your own hedge fund manager. You can run your own endowment.
Yeah, no, that makes a lot of sense. I mean, you're just starting with something simple and then adding those little pieces of layers of alpha, really, that have been shown to consistently work over long periods of time.
Yeah, exactly. Trying to synthesize it down where, it's not like smoke and mirrors in like academic journals, but it's in plain speak and, where someone can actually digest it and try to understand. In the book, we try to explain like, why does this work besides just, we know it works in a back test, but what is the behavior? Right. What is the reason why, this has worked for the 100 years prior and it'll probably work for the 100 years in the future.
Exactly. So what is it about the human element that creates these opportunities? Yeah,
exactly. And actually, you highlighted in the very beginning, or I guess a question or two back, it's all about discipline and realizing that any system that actually works will underperform and get you fired as an asset manager at some point. That's why it works, because a lot of capital doesn't want to deploy that because they like their jobs. They don't necessarily like after tax, after fee, long-term compounding.
Yeah, that's not where their risks are lined up.
Yeah, exactly. That's what they're supposed to do. If you manage money for someone, you're supposed to have a long-term horizon and try to maximize the expected after-tax, after-fee compounded risk-adjusted return. But that's not what you really do, because most people want to keep their job. So they focus on optimizing for career risk, minimizing that, not necessarily, doing what they're supposed to do in theory.
Right. So our bonus question we always ask, this is about a book recommendation. What do you have for us today?
I'm trying to think book recommendations. You want a finance one or something a little bit out of the
you had mentioned something previously about the Constitution. I was curious what you're going to go with that one.
Yeah. So I mean, honestly, it sounds crazy, but I just been spending a lot of time, kind of reading back just the original U.S. Constitution and the associated, like the Anti-Federalist Papers and the Federalist Papers. Mm-hmm. I think are really good, because what a lot of people don't understand is like the Federalist Papers is actually the argument for big government, and the Anti-Federalist is obviously the argument for like basically anarchy. And when you read the Federalist Papers, which are the guys arguing for big government, and you compare that to what our current situation is, you're like, these guys sound like, right-wing radical Tea Party guys. And they were literally the guys arguing for
They were on the left at that point.
Yeah, they were like the lefty guys, like the Bernie Sanders of their time. And it's just really, I just think it's a really good kind of base out and framework to understand, because we've already been talking about these things for so many years, and they kind of figured this out back in the day. And the U.S. Constitution is a great thing to start with, and obviously it was a compromise amongst a lot of varied interests. But reading the associated arguments in the Anti-Federalist and the Federalist Papers, I just thought were really interesting, especially in the context of, presidential election coming up, all this big government crap where, the fact that we are so tuned in on the Fed and their every move makes no sense. We're literally waiting and baiting and listening to what a government institution has to say to drive all private investment and allocations in our lives. Yeah. That's like the antithesis of how it's supposed to be set up, in a free society. Like we shouldn't have to be, praying to the Fed god to see what they're going to do next.
Yeah, for 25 basis points.
Yeah, and that's clearly what we've set up. Our current setup is like. And when you step back and you look at the history on the whole shebang, you're like, this is insane. Like, what the hell do we got going on right now? So, anyways, they're not books, but I guess the Federalists and Anti-Federalists are, but U.S. Constitution is not a book. It's just a legal document, but it's kind of fun to just go back and read it. It's interesting.
Wow, that's great. Hey, Wes, we always love having you on the show, and thanks for taking time out to chat.
Sure. Appreciate you having me. And everyone check out DIY Financial Advisor. $15 on Amazon. Easy.
Yeah, it'll pay for itself pretty quickly.
Yeah. Hopefully. You never know.
All right. Thanks.
Yep.